Well, we're going to start Chapter 8 with a discussion of risk and return. In most decisions we make, whether they be financial or not, I mean, there's two things you're kind of looking for, two things you're analyzing. One, of course, is what benefits do you get if you do this thing, if you buy an asset, or if you participate in an activity, what benefit do you get from doing that? And then the second question has more to do with uncertainty. What's the chances it will happen? What's the chances that something wrong will happen? So from the financial context, we obviously want to incorporate both risk and return into our analysis. It's that combination of risk and return that we've been talking about for the last several chapters. So we're going to start talking about how we analyze and calculate returns and risk for individual assets, and then we're going to move and talk a little bit about a theory called the capital asset pricing model when we get to part 2 of the chapter. So there is a definition, of course, that we need to understand. That is of a portfolio, and we'll bring this to light again when we get to that second part. But a portfolio is a collection or a group of assets. Sometimes people would say, this really sounds like an investments chapter. Well, why are we discussing portfolios in corporate finance? Well, one of the definitions of a corporation is it is a portfolio or a nexus of assets and contracts. So a corporation has some of the aspects of a portfolio when we start to combine different companies, the different assets, different product lines. So there is a portfolio flavor to the creation of a corporation. So risk obviously involves uncertainty. It talks about the chances that things won't occur the way we want to. So frequently we'll use the word uncertainty. We'll talk about variability, how things change. Sometimes a better word is even volatility. Return is obviously what you think it is. It is actually the gain or loss that you get if you purchase an asset, or it's the gain or loss you expect to get if you think about buying an asset. This adage certainly seems to hold true for most things in life, but you would think that relatively intelligent investors would understand this idea of it's too good to be true. I'm sure most of you have heard of Bernie Madoff. Basically created and ran one of the biggest scams of all time. In the tens of billions of dollars is what he frauded investors over. And so how did he do this? Well, in a time when the financial marketplace is in a downspin, that people were having a hard time making money, Bernie is promising to get 10%. And he provides documentation that he can do this. Well, nobody can do this. It's too good to be true. In a down marketplace, you can't produce the same kinds of returns that you do in an up marketplace. So the challenge I think that we as investors get is that we need to really use some common sense when you're investing. I mean, these smart people, most of them fairly wealthy, really fell into this trap, I guess, of thinking that since they were wealthy, they were entitled to these special kinds of deals that Bernie was marketing, and they got trapped and they got caught. So again, if it sounds too good to be true, it almost always is, right? If something sounds like it's free, you're probably getting exactly what you pay for it. That's another nice phrase that I like to toss around from time to time. So let's talk about returns. How can you calculate the rate of return on an asset? Well, we need to know what cash flows are going to be paid by this asset, or what cash flows have been paid. So you need to know if this is a stock, it's potentially the dividends that were paid over this period of time. We also need to know the capital gains. How much profit was made from the purchasing price. So T is the time today. T minus 1 is what it was last period. So this is the change in price plus cash flows divided by the change in price. And that's certainly a decent formula. It's a formula that fits most returns. I just think algebraically it's a little tougher to understand and deal with, especially when we want to go one step further. So what I would like us to think about is a different formula. And in this formula, it's the same exact formula, except we need to have a variable that's going to help us to annualize the data. Here we have two companies, right? At the beginning of the year, Apple was selling for $411. At the end of the year, it's selling for $532. It paid dividends of $5.33. We also have Walmart stock that went from $60.33 to $68.23, and it had $1.59 in returns. So using our formula before, you can see that the return on Apple was 30.7 and the return on Walmart was 15.73. There is a worksheet that we're obviously showing here that is the holding period return worksheet, HPR. So how does this ultimately work when we talk about returns? What does real life show us? Well, real life shows us that there are, in this case, we're looking at 4 primary assets: treasury bills, corporate bonds, big stocks, and small stocks. As you can see, as you go up the list, we go up the list in returns. Treasury bills have the lowest returns. Small stocks have the biggest returns. So how can we reconcile that with the topic of the chapter, which is risk and return? Well, our measurement of risk as we work our way through here, one of the measures is something called standard deviation. It measures volatility. And as you can see, with these 4 securities, with these 4 classes of assets, as risk goes up, so does returns. So they are related to each other. They make some sense that risk and return are tied together. Now, a couple things that people typically ask me is something, well, what rate of return should I expect if I invest in the stock market? Well, large stocks have averaged 11.7%. And I'm pretty careful about my language when I talk about returns. I almost always use the word average, because I don't want you to think that you're going to get 11% every year. It's an 11% per average. And that's really what you want. You don't need 11.7% a year. You just need to have, over a period of time, you need to be able to earn that kind of money. And of course, this goes from 1926 to 2011. So if the implication here is if you hold a large portfolio, let's say it's S&P 500 stocks, you're going to average around 11.7%. Certainly you have over the last from 26 to 2011. Now, what has happened in the stock market since 2011? The stock market is growing. In 2013, the stock market averaged roughly 30%. So this number is probably not influenced a great deal by that, but it's probably a little bit higher than that. But if you wanted to really look into equity investing and you were willing to take some risks, small stocks actually earned about 18.7%. I mean, could you imagine earning on average 18% a year? Again, people say, well, you just can't do that. Well, the challenge is time. This time frame, right, is 74, is 85 years of history. Will the next 85 years be the same as the last 85 years? I would say absolutely it will not be perfectly like that, but it will be close, because the stock market is a series of cycles, and those cycles continue on. They go up and down as time goes by. Again, think about risk and return, though. If you want 18%, you're also going to take risks that you won't get those 18%. So how do investors look at risk and return? And in particular, how do they envision or think about risk itself? Normal people, right? Rational people, I shouldn't say normal people. Rational people should be what we refer to as being risk averse. They recognize risk, they see risk. They don't see risk as necessarily being a bad thing, but when they see risk, they want to get paid for risk. So they want an increased return when risk changes, when risk goes up. A person that's risk neutral is a person that really doesn't pay attention to risk at all. They don't care what happens to risk. It doesn't influence their decisions. And frequently people will make some mistakes because they're really only going to concentrate on the return side. A risk-seeking person is a person that as risk increases, they are willing to take lower expected returns. And I know that sounds a little bit silly, but really risk-seeking activity is gambling. A risk-averse activity is investing. So when you're gambling, by definition, since the word is gambling, you expect to lose money, right? When you go to the casino, you don't expect to leave there with more money every single time you go than when you left. If you did, they wouldn't call it a casino, they'd call it an investment parlor. So how can we measure risk? How can we analyze this number? Well, there's a couple of approaches that we'll talk about. The first one is something called a scenario analysis. We're going to assume that we can predict something into the future. So we want to find out or predict what's the worst thing that could happen to me, what's the most likely thing that could happen to me, and what's the best thing that could happen to me. So we want to make some predictions on prices. If you predict prices, then from that we can calculate returns. Now the range is a very simple measure of risk where you just take the worst outcome and subtract it from the best outcome. Essentially it's measuring a distance, if you will. Unfortunately, the range doesn't give us any real feel for how likely this range is going to happen, or how likely the worst and best things are going to happen to us. So the scenario analysis allows us to adapt this probability of occurrence. So let's talk about a couple of assets. We have assets A and B. We're going to invest $10,000 in both. And if you bought asset A, the best thing that could happen to you is 17%, and the worst thing is 13%. For B, the best thing's 23%, and the worst is 7%. Now the range of these, 4% is the range for A, and 16% is the range for B. Now, from a strictly just looking at range, we can see that asset B has a greater range, has more distribution than asset A does. We need to incorporate, though, or provide now some probabilities. What's the chances that these outcomes actually occur? So we have to give or create what's referred to as a probability distribution. We have to assess or give a probability to each particular outcome. Now the underlying theory here is that we're going to assume normal distributions. That is that the predictions that we're talking about in the future have a normally distributed distribution of outcomes. So now we're going to take this company and we're going to say there's a 25% chance of pessimistic, 50% chance of most likely, and 25% chance of optimistic. And all you need to understand, at least at this point, is that that adds up to 100%. So that's the entire spectrum of possibilities. So let's go back now and look a little bit closer and look at our returns and how we calculate the risk and return for a particular asset. So here's our formula for returns. Now we can calculate the average or the expected return one of two ways. If we're using historical data, if we have a data set that has the returns, say for the last 10 years, we can calculate the average using this for a sample size distribution. But we're talking about prediction. We want to predict what do we think is going to happen in the future. So the formula that we're going to use says find the probability of a return and multiply the return by that. Do that as many times as possible and then add those all up. The standard deviation that we calculate then is going to be a measure of dispersion. It is the statistical indicator of the asset's risk level. So we'll see how that works as we move on. The formula for standard deviation is kind of difficult. It's kind of complicated. But again, let's think about in general what we're trying to measure. We're trying to measure if what we think happens won't happen. What's the chance that something different occurs to us? So by definition, R bar here is the return that we expect. The R is one of the outcomes. So there's a chance that we don't get the average and we get this other possible outcome. We then multiply that by the probability. So this is just a measure of the chance that we don't get what we want. The sample size calculation is also over here. So again, the higher the standard deviation, the greater the risk, the greater the dispersion. Now there is another measure of, I'm going to refer to this as relative dispersion. It measures risk, but it does it in a different sort of way. It's called the coefficient of variation. And you take the risk, standard deviation, and you divide it by the average or the expected returns. So when you do this, in the end, you're going to end up with a number that says, well, how much return or how much risk do I take for every 1% of return that I receive? So again, it is a measure of relative dispersion. Well, here's our spreadsheet that's the standalone risk worksheet. And here are the two formulas that we had, or the two assets, 17, 15, 13, 23, 15, and 7. And here's the expected returns. Now, what you might not understand or have seen just from the numbers is that both of these have the exact same expected return. So the average return, if you buy A, on average, you will probably get around 15%. If you buy B, you will get 15%. What's different, though, is the risk level. For asset A, standard deviation is 1.4, and for B, it's 5.6. So B is showing that it has standalone risk that is greater than A, even though it has the same rate of return. Now, the coefficient of variation helps us with the comparison. As you can see, the number 0.09 for A versus 0.37 for B says that A is absolutely the lower risk asset. So if these are the only two things you could buy, both of them are going to give you on average 15%. Which one would you purchase? And the correct answer, the answer of the rational investor is, I would like to get the 15% that has the most likely chance of occurring, which is asset A. Now we also have another asset that I've added here. -4 is the average return, or is the best possible return. 7% is the next lowest, or the average, and then 12% is the bad return, or the pessimistic return. And again, we can look at this and we can see that what? It has a lower return than the other two assets, but it also has a higher risk level. So it has less return, more risk. So we may be suspect about how we ultimately want to invest in asset C, since it has higher risk and lower returns. We're going to use these three assets later when we get in and talk about portfolios. You can see here that there is a calculation already for portfolios. When we get to that chapter, we're going to add here the actual investments in assets A, B, and C, so we can see the statistics for the portfolio itself.